Good morning, good afternoon, and good evening to all of our crypto fans out there. You have your gracious hosts, along with a repeat guest, Nicholas, who's going to be joining us all the way over in Europe. He's out in Germany, so we've got a early morning edition here on the East Coast. Everyone's got their caffeinated beverages, or as Carlos usually is having his mushroom roundup mushroom beverage. Is that still the case over there,
Ooh,
Carlos? Mm.
yeah, I mean, you gotta stick with what works, my friend.
That's amazing. I love it.
I'm,
I
I'm,
love
mi-
it.
I'm
I love
micro I'm microdosing mushrooms over here,
it.
but not the psychedelic kind.
Like, yeah, just like getting into the higher dimensional matrices of algorithms for all of your trading
Yeah,
strategies. I love it. Nicholas, how you doing, man? It's great to have you back on the show.
Yeah, hello. Thanks for having me back on. Doing great so far.
Excellent, excellent, excellent. But you have are you? It's like an early afternoon, so you're kind of in between coffee and a beer beverage. So I don't know, you're
Yeah,
drinking green tea or
not
something over
quite,
there.
not quite yet. Time for beer, so it's still coffee.
Yeah, nice.
Still coffee for me. Yeah.
Nice. Nice. Awesome. Awesome. Excited to have you on. When we were on before, you had some really fantastic comments around some of the dilemmas that we can have with block space. Remember, we were touching on topics such as trading around gas fees and how you can kind of game some of that systems and kind of maximum extractable value. And so we were really excited. I know Carlos and Matt and I were really excited to have you on to chat a little bit more about Uniswap. Obviously, they're coming out with a new version V4, which has a lot of new interesting characteristics. I think it's going to be a really great show. Hopefully, we'll be able to dig into a lot of details and talk a little bit more about pros and cons versus prior versions. But before we dig into that, I know generally, obviously we talk a little bit more about macro themes and some news, really interesting news came out. Carlos, I know you had dropped in some of the show note comments before we kicked off from Larry Fink, an interview from Larry Fink just about how he's thinking about the digital asset space. Obviously, they put in for a new ETF for BTC. And in that interview, he was also talking a little bit more about some of the interesting capabilities that can come from tokenization of assets on a blockchain, which obviously we've talked on that a little bit, but it's great to see the CEO of the largest asset manager in the world talk about that too, because they obviously do quite a bit in assets.
definitely. I think I watched the interview, and Charles Gasparino, who is sort of one of the, we'll call him like an old school like boomer cable news TV guy, was pressing, you know, uh, Larry Fink on sort of what's the utility, and his words were like, I know a lot of people who own Bitcoin, but what do people use this for? It's not clear to me there's a use for it, and it was shocking to me that Larry Fink, who in previous years has basically said Bitcoin's really only used for scammers and drug dealers, and uh, recently, in this interview, basically said, no, hold on, stop right there. There's a massive utility for the tokenization of assets, the ability to provide fractional shares to retail holders, and then said that basically the whole underlying mechanism of finance has the ability to be disrupted along the same order of magnitude as when ETFs disrupted the mutual fund industry, um, when assets have the ability to be tokenized. And I think that the media really played on the concept of him saying we're confident we're going to get the Bitcoin ETF, done, and he made a statement about digital gold. But for me, like the real alpha in looking at that was this concept of you've got a $10 trillion asset, under management firm that is focused on the concept of tokenizing assets, and that to me is one of the biggest indicators of sort of like the overarching utility use case for crypto. Like a
Yeah.
lot of people focus on this concept of like, oh, well, you know, I don't really see any consumer applications like Google that I use every day and that sort of stuff that, like those Web 2 businesses that are a clear indication of product market fit for something like the internet. So where's that for, for crypto. And I guess my statement is, if you take away and shelve every single consumer-facing application, which there will be consumer-facing applications for crypto, but let's just say you side that
There
and you take
isn't.
all those
Yeah.
down to zero, as just a thought experiment at the at the boundary condition. If you took that and said there will be zero consumer applications for crypto, the only thing that it will do is it will become the underlying sort of fascia for the way that money moves throughout the financial ecosystem. That to me is still a multi-trillion-dollar use case.
It's easily, if not hundreds of trillions of dollars, right?
Yeah. So like, if you don't believe there's utility in crypto, you're not looking hard enough and you don't use it. And I think that, more importantly, when you think about the tokenization of all assets, to me that's the most compelling use case there is to really develop a core competency as a firm in DeFi. Because with that, there is going to be completely different paradigms of moving money around, programmable money, and so even if the DeFi protocols that we know in their current form don't end up existing in future iterations, you can think of them almost as sort of like proof of concepts that will then get taken. Concepts will be borrowed, and they will become sort of like the new utility frameworks under which finance operates. So, from my perspective, I think it's kind of an interesting thing, and the fact that the CEO of the world's largest asset manager was indicating that was one of the things that they were excited for in terms of using blockchain technologies is pretty cool.
Yeah.
And they indicate, I guess too early, but if they'll allow transactions for all their stuff to be on blockchain? So I think that's really interesting. There's a lot of like ETFs were originally touted as being able to provide transparency to the market on what's going on and easy access for people, but that, like, I'd say they became a lot more opaque in terms of how actually positions are closed and everything. So there's an easy way to then just have this on a public blockchain, and then people can kind of infer, even if it's kind of released at the end of the day, like as a data center type of thing. I don't know what the plans are for that, or if it's just for issuance only.
Here's the thing: we're talking in cable news, so it started. Sure. It's basically 30-second sound bites, and that's about it, because that's what people have the attention span for on those things. So it's left to the public to sort of read between the lines and then say to themselves, what are the likely use cases? What are the things that could happen? And I think that's a pretty clear use case of sort of like, if you're going to have ETFs run the show, how can we incorporate blockchain to manage, accounting, settlement, custody, for those, ETF structures? It's kind of a no-brainer for me, right?
Yeah.
And then it's also how those assets are then traded, those tokenized assets are then traded, right? Which I think ties really well into the main topic for Uniswap, right? Because as obviously you can have like end to end. It's one thing to also be packaged. I think that's one of the things that you had mentioned also that Larry touched on, was just the packaging of the assets becomes a lot more composable, because you can use fractional ownership for other large assets. But then how are those things transacted over these new payment rails, which, to your point, ties really well into Uniswap and how like some of these decentralized exchanges.
Yeah, I think before we get fully into Uniswap, I think Uniswap is a key part of the infrastructure. I fully believe that. I think Uniswap, in my mind, is probably one of the biggest pieces of like a public utility infrastructure that exists on the blockchain right now. And for better or for worse, its home is on the Ethereum blockchain. And a lot of the main sort of protocols, or not protocols, we'll call them protocols, like basically utilities that exist on chain at the moment in its present form, are built on Ethereum. So the one thing that I think is hilarious is that there are a lot of like Bitcoin maximalists, and for full disclosure, I own Bitcoin. DQ Digital deals in Bitcoin. We're not anti-Bitcoin, but I think it's an important thing to understand, sort of like why we think Ethereum is likely the best home for DeFi to exist. It's not immutable; like that could change. But my personal belief is that that's the case. I don't know, Nicholas, do you have any thoughts in terms of like where we are from like a technical perspective as well as just like a market perspective? Why Ethereum is so entrenched at the moment?
Yeah, so we've seen a few different factors coming to play over the past few, let's say, cycles. So one is, of course, that Ethereum still has most of the liquidity that is on blockchains, right? So that's obviously a huge lock-in factor, and a lot of competitors to Ethereum, I think, had a lot of problems. Like, even though they solved things like scalability or were cheaper than Ethereum is, they just don't have the liquidity to support like actual trading volumes. That's certainly one thing. And then on the technical side, one trend that we've seen over the past, let's say, year or so is that all those competitors to Ethereum have more and more moved towards becoming like layer 2 solutions to Ethereum. So it very much looks like we'll, at the very least, keep Ethereum as like the settlement layer, that the cryptographic security layer that sits at the bottom of the stack, and on top of which individual layer 2s appear and might solve specific, very, very focused user needs, offer like advantages, like much more transactions per second that can be processed, and these kinds of things. But then it very much seems that Ethereum will be sort of the liquidity layer underneath, where in the end may it even be like end of day things are settled, and then like the huge volumes still live there, huge amounts of liquidity still live on this chain.
So I guess I have two questions for you, Nicholas. The first is, what would it take for Bitcoin to develop a similar ecosystem? And this, like, once again, this isn't to hate on Bitcoin. I think it's just important to note sort of the hurdles that are in place for Bitcoin to be able to get to the point that Ethereum's at currently. And the second is, what advantages does Ethereum have in terms of like a base settlement layer over some of the other, L2s, like for example, like Avalanche or Solana or something like that?
So first of all, on the Bitcoin topic, I think the sort of one-line summary is that Bitcoin just wasn't built for this. Right? Bitcoin was the first cryptocurrency that was like widely available, widely popular, and it sort of brought to mainstream this concept of having like blocks and connecting blocks in a cryptographically secured way in order to transact money. But what Ethereum added, and that was sort of the huge innovation of Ethereum, was to add like a computer on top of that. Sort of the technical term is like a Turing complete state machine in a way, right? So you can run an arbitrary programs on top of this blockchain, and you just can't do this on Bitcoin, at least the way that it stands right now. For Bitcoin to catch up to this, it would need like all of this tech to be built, implemented, and then it would need a hard fork. So the existing Bitcoin nodes, the miners that are running the chain, would need to all adopt this new paradigm, which I think is quite unlikely. So there have been approaches to circumvent this, and there was like a hype in NFTs that were living on Bitcoin. I think ordinals is the term here, which were using some oddities in the way that Bitcoin is set up, and there was like sort of additional fields in the blocks that you could populate and that you could use in order to build something sort of like a computer on top of Bitcoin, but it wasn't really built for it. So
yeah,
I
think to me that's one of the big pieces here, and more so than it just wasn't built for it, which is absolutely true in my opinion. And you touched on this as sort of like the degree to which all of the stakeholders in Bitcoin will have to move over to a new way of thinking and a new way of monetizing the protocol is going to be really difficult to do. Because you're going to have miners who agree that like, yeah, guess what? Like, we're just no longer going to be as critical of a piece of the infrastructure. And you're going to have developers who are going to have to, agree to it as well. Like there's a lot of stakeholders at play, and it's akin to sort of like, changing the engine of a 747 mid-flight, and that becomes very difficult to do.
Yeah, and like a lot of the stakeholders are very risk averse in this sense, especially for Bitcoin. And I think in the context of Bitcoin being like digital gold, this also makes a lot of sense. You shouldn't really touch that too much. The way that Bitcoin is running right now is very much battle tested, and adding completely new systems on top of that obviously introduces huge amounts of additional risk that many people just don't want. And I briefly mentioned this NFT stuff that was running on Bitcoin. A lot of people became very critical about this, also because it was starting to congest the blockchain, was making transactions much harder and more costly. So I don't really see Bitcoin developing towards this due to these exact reasons.
Yeah, and I guess then moving on to the second question, which is, I guess that's one end of the spectrum, right, where you've got Bitcoin, which has made the firm decision to be like a secure base monetary digital gold layer. Ethereum that I think kind of lives in this Goldilocks universe. And then on the other end, you have these hyper fast, ledgers that ultimately make some trade-offs in order to get the speed and the scalability that they need. I guess, where would sort of these like alt layer ones live, like Avalanche, Solana, so on and so forth?
So what is interesting about some of these approaches is that they use more or less the same technical setup as Ethereum does, like this Ethereum virtual machine, it's called. So in a way, they're just copying what Ethereum came up with and trying to get it to I don't know, higher throughputs, for example. And I think this is also where one of the issues comes from that these solutions encounter, and that is like they have a lot of like just taking that system and I don't know, putting all all parameters to the maximum possible introduces a lot of issues. So we see, for example, Solana, which has a lot of stability issues, so in contrast to that, Ethereum is much more battle tested as well. It's been around for like close to 10 years, I think now. It's working very well. It has a huge community of developers that are maintaining it, and a lot of solutions and a lot of improvements for it have been like carefully designed over many years, cross-checked by many different developers, many independent developers. And I think this is something that is very hard to replicate, right? Especially the sort of the community that was built around Ethereum. And then add on top of that the liquidity that's already there, and the ecosystem that also has a lot of like liquidity to spend on these kind of improvements. Like the Ethereum Foundation is giving out a lot of grants, for example, for these kinds of improvements on the core technology. And I think that's just something. Well, many alternative chains that have tried to replace Ethereum have, ultimately realized this as well, and so many of them started to divert towards like becoming a layer 2.
Do you think it's materially more challenging to have, like, for example, Solana, since you touched on it, they have they're trying to do everything in one single chain, whereas Ethereum is trying to have different layers to help different accomplish certain goals. That might also just be exponentially more challenging to do, and that coupled with what you mentioned, the first mover advantage that Ethereum has, makes it a Herculean task to try to catch up to Ethereum in terms of throughput and community development liquidity.
Yeah, I think this is certainly sort of one thing that has stopped them from like gaining huge success. And I think one other factor that one should consider here is like Ethereum is really very well decentralized. And then these additional solutions, because it's such a challenging problem, they've tried to attract a lot of VC funding, for example. And for this, like this has led to a lot of centralization and also intransparency. And that is obviously also not well liked by the community. And then if you have these technical issues and no one really knows the code except for the core maintainers, which are controlled by one or two firms, just simply doesn't seem to be like the recipe for success in this space.
Yeah, I think the Ethereum Foundation have done a fantastic job of keeping direction and focus as well, at least from following their stack quite a bit.
Yeah. I think this also kind of falls into so the unholy trinity of like DeFi scaling, which is effectively you can have two of the following three, which is decentralization, security, and scalability. And I think that anyone who has made the choice to optimize for scalability ultimately ends up giving up a little bit in terms of decentralization and security. At which point you may as well default to more of like, a standard database architecture on the cloud.
Yeah.
So I do like the idea that for all the criticisms, I think that Ethereum has done a fantastic job of doing the best it can to be decentralized and maintain like a very well tested security model. It's not as scalable, but I do think with the advent of layer twos, you're going to get significant, increases in scalability, which makes it more usable for adoption at a, broader scale. So I think that right now you're sort of at this like inflection point where we're getting to the point where Ethereum plus the combination of L2s opens up the ability to have like a product that's usable at scale, almost like internet's broadband moment where, it used to be like, I remember when I was a teenager, I would spend like 8 hours trying to download one MP3 song with Dave Matthews Band or something like that. And now it's just instantaneously usable at any moment I want to.
Or you spend days doing it, and then there's a cut in your internet for like a second, and you have to start all over again. Oh, that was great.
I know.
I loved it.
Yeah, absolutely fantastic. The levels of pain that I went through back in the 90s to develop mixtapes for girls in my junior high and high school class was just astronomical. But now you can just send a link to a playlist and it's all done.
It's a lost art. It's a lost art, Carlos.
It really is. So that being said, I do believe that we're kind of crossing the precipice now where, Ethereum, even a couple of years ago, or even last year, the year prior, was slow, expensive, and, with Shanghai and, L2s, Matic, Arbitrum, et cetera, coming on board, I think you're really getting to the point where you can actually, trade and do like meaningful types of, financial activity on chain.
Yeah, and I think what we've seen, like you said, Uniswap is like deeply rooted into Ethereum, and I think this is a good like prototype of how such a development process can work. Right, you build a protocol on Ethereum, on the Ethereum virtual machine, so you have a nicely well tested framework on which you develop this, and if it works there, well, it might be a little bit too costly to work in scale, at least for like smaller amounts in the case of Uniswap. But then you just move it to the L2s like Arbitrum or Polygon, Matic, and there like you use the same framework, the same technical setup, but sort of with much cheaper transactions in this case. So I think this is sort of the prototype of how such a how protocol can evolve, starting on Ethereum and then moving towards the sort of outer layers of the stack.
Yeah, I love it. I think that's really important, and I think there's something that we realized as a firm, going through the process of moving from traditional finance into crypto. And at first, what you try and do is you go from traditional finance into crypto, and you say all the stuff that I did in traditional finance, I can now just do in crypto on centralized venues. And life is beautiful. And then you realize, hold on a second, there's this whole awesome world of things that are brand new and only available within the context of crypto. And some of them are like just not good versions of things that you can already do in TradFi. But then you also throw into the consideration that as we go down this curve of transaction costs getting cheaper, scalability and speed within DeFi, as you get to Uniswap V3, you suddenly actually have something really cool that you can use to trade and make as much money as you could on a traditional finance perspective. And then you add in V4 and then V5 and so on and so forth. I think you kind of get to this point where sooner or later, you get usable tools in DeFi that are as good, or in some cases, better, that are providing, true innovation in the space. And you'd be remiss not to keep up with the curve at every step of the way. Which is why I think I wanted to bring on Nicholas today to kind of talk about what we get in Uniswap V4, how that's interesting, and what sort of innovations that paves the way for, in terms of our ability to transact finance on chain.
Yeah, why don't we cover V3 quickly then, just to recap. I know we went over it last time, so we'll have to go into a ton of detail, but if you want to give a rundown of pools, how they're set up, and then we can go into like what's new, what's different about V4.
Yeah, I think a good way to start is by looking how V3 improved on V2. So the problem in general that Uniswap tries to solve is offering an exchange where people can trade tokens, like usually pairs of tokens. There are other like decentralized exchanges where you can trade more than one, or where you could can trade between more than one or more than two. Sorry, where you can trade between more than two different tokens. But Uniswap always entirely focuses on this paradigm of having pairs that you trade. And the way that it's set up is that you pool the tokens into a pool, which is like a smart contract that lives on chain and works without requiring like any centralized actor to provide liquidity or to run it, because it's run by the blockchain. So back in V2, we had just pools, and then people could, like liquidity providers could provide liquidity to it by depositing, I don't know, ETH and USDC, for example, into a pool, and making that available as liquidity to others, to traders that would want to swap one for the other. The big issue there was that you would provide the entire liquidity across the entire price range. So that became inefficient for liquidity providers. The big innovation of V3 was to add concentrated liquidity. So now all of a sudden you could decide as a liquidity provider to not provide ETH and USDC across the range from 0 to infinity ETH per USD price. But you could very well specify this within a like small or very large range of prices where your liquidity would become active and participate in these trades. That sort of was a way to increase, or on the one hand, to increase liquidity or to improve the situation for liquidity providers and thus increase liquidity. But on the other hand, it also made available some new features, right? You could all of a sudden do a lot of new things just by specifying what range you would want to provide your liquidity in. So you could, for example, do now on Uniswap V3 just provide liquidity in one single token if you would provide in a range that was above or below the current price entirely, depending on which token you want to provide. And this allows you to do things like, in theory, sort of simulate limit orders on Uniswap, with some issues as well, because you would still need to sit there and act if price crosses your range. It wasn't automatic. It was like a perpetual limit order that was living on the book since you until you would close it. Uniswap V3.
So let's dive into that really quickly. So for people not watching and not thinking about this, right? Like a limit order on a central limit order book basically means if the price is at 100, I can put a limit order that basically says if the price goes down to 80, buy. And so if the price moves down to 80, that order gets triggered, and whiz bang boom, you're now the owner of some asset at a price of $80. If the price goes below 80, right, and then comes back up, you don't have to sell at 80, right? On DeFi, the way that the contract's set up is if you put a pool of liquidity in at the tick around 80, the price goes down, and you're now suddenly the owner of the asset. But if the price goes up again, well, it's like a switch. It triggers again on the upside, and now you've sold. And anytime the price crosses 80, you're buying and selling in perpetuity until you actually remove the contract. So as Nicholas was saying, like, it's cool features, but it's not quite a limit order because it still requires you to interact with the contract, and it requires you to manually or programmatically watch it off chain and spend gas each time you do it, which I think is sort of like, it's a cool thing, but it's not quite as good as a limit order yet.
And so Carlos, so you would the way the V3 would function on Uniswap, so you'd buy, to your example, at 80, it would be buy on the way down to 70, and then if it crossed it again, it would buy again. So you'd double up your order, or would it buy?
No,
and then sell?
meaning you, when it goes down. So the way that Uniswap V3 works is you select a range of liquidity, right? When the price goes down, then you're buying the asset, and then when the price goes up, you're selling the asset. So you're effectively providing liquidity, and you're wrong way whatever the market is doing. So if the market is going up, you're selling. Market's going down, you're buying.
Buy high, sell low.
It can. I mean, that's exactly the game that you play as a market maker. So this is just a simple version of that. And the thing is it's dumb, right? It doesn't have any logic. The only thing that it says is anytime the price goes within the upper and lower bound of this range, when the price goes up, right, we sell, and when the price goes down, we buy. So you're providing liquidity on the way down, so the price goes down, and suddenly you're now the owner of the asset. If the price then goes up again, you're suddenly a seller of that asset. And that is actually kind of like, that is actually the name of the game with market makers. You're kind of hoping that the price kind of like stays within that boundary, and you're just collecting fees the entire time. Your goal is not to own the asset or sell the asset. Your goal is to make money on the fees. A limit order is somewhat different because it's only going to get triggered one time, right? You're basically saying I have a price at which, well, it's like a reserve price at which I'm willing to buy or sell the asset. And when that gets triggered, then that's the price that I transact at. End of story.
Yeah, in a way, it would be like, as soon as your actual real limit order got triggered, it would be converted into a limit order in the opposite direction, right, at the same price automatically until you pull it. That's more or less what happens on Uniswap if you provide liquidity like in this way.
And so Uniswap V4 is an evolution of that, now providing essentially a limit order. Is that correct?
So
not quite. It provides the Lego blocks that allow you to do stuff like make a limit order.
So one of many options.
Exactly, and I think sort of this limit order example is one good example where like Uniswap V4 really gives a lot of advantages, but there are also, like, maybe before we really get there, there are a few more other issues that the Uniswap V3 has, and one of that is it's very expensive. Each pool lives in a separate smart contract, and you have to deploy that contract, which costs gas, for example. And then also each pool holds the tokens like by itself. And so if you want to not do just one swap from ETH to USDC, but you want to do like multiple swaps, you want to hop along different tokens, let's say from ETH to USDC, and then from USDC to Bitcoin, for example, or wrapped Bitcoin, that is, then you would need to do a lot of token transfers. First, you would need to transfer your ETH to the pool, to the ETH USDC pool. Then the pool would transfer the USDC back to your account. Then you would have to transfer the USDC from your account to the USDC BTC pool, and so on. So that's
which I think, Nicholas, that happens with the automatic routing anyway, does it?
Exactly. So since you have many different pools, and I don't know if you want to exchange ETH for Bitcoin, there might be a pool that pools ETH and Bitcoin, but it might be more capital efficient. You might pay less spread, for example, or have less market impact if you route that not directly from ETH to Bitcoin, but if you route it through many different pools. And this has given rise to a lot of like decentralized exchange aggregators, like 1inch, for example, is one of the most popular ones. And then, like you said, the Uniswap itself has integrated that across its like Uniswap universe, that if you go there on their page and swap from one token to another, you're most of the time is actually going to be routed through many different pools in between. So that might be more capital efficient. You might pay less spread, but you will pay more gas fees for this. And this is one like a really big issue, especially on Ethereum. And we've seen other protocols come up with solutions there. And the most straightforward solution is to just not separate the tokens to different contracts, but to keep them all in one central place, and then do this routing sort of internally as the swap happens.
Now, one thing to note about this, and I think this is actually kind of a cool space where I would say there's a notable innovation in DeFi land, right? So I'll use the analogy of FX. It used to be in FX that there was this whole business of what were called triangle arbitrages, right? And a triangle arbitrage is really just this concept of, let's say that I've got some triangle between euros, yen, and dollars. And if somebody wanted to buy euro yen, right? So someone in Europe wants to convert their dollars and their euros into yen. What they might find is that it's sometimes cheaper to actually convert their euros to dollars and then convert those euros into yen. Now, if I, as a customer, go to a bank and say, cool, what I'm going to do is I am going to buy euro yen, and I'm going to pay X amount of spread and fees for that. The bank might find that it's actually better for them to first transact in euros to dollars and then from dollars to yen. But who keeps that? It's not the fucking customer, it's the bank, right? So if you have built into the protocol level, basically like best execution across, number of hops, right? And then that goes to a better execution for the customer as a matter of code, rather than basically saying, all right, let's let arbitrageurs and, banks and market makers basically extract rent from the system, and they get to keep the extra benefit of basically doing this, triangle arbitrage and enforcing the price of all these sorts of things. That's actually kind of a cool feature, and it's built in to the protocol as a matter of like principle.
Interesting. Are there? I find that fascinating because I know that one of the things that we've talked about with DeepQ Digital and some of the strategies that are employed within your market making strategy is that DeepQ Digital is a risk warehouser, so they're actually taking a view on the movement of assets versus just pure arbitrage, which I know a lot of other market makers do. So they're looking for those type of. I'm assuming that those other HFTs are looking for those type of triangle-like arbitrage opportunities. And if they're getting coded away, I assume it would be more challenging for some of them to generate profit in a pure arbitrage way. Are there other? Maybe this is a little outside of the scope of the conversation, but I was curious if there have been other thoughts around other arbitrage opportunities that exist or that are common that maybe are trying to get removed via protocol development within something like Uniswap.
So this is actually an interesting point. Because that leads back to our conversation we had last time. Because the arbitrage game in crypto is MEV now, right? You might have that you route these orders directly in code in the protocol and like give the benefits you get from that directly back to the customer. But then you also have many different pools that might become out of sync if you do that, right? Where the price might deviate, and so that's then where, like, once after such a transaction happens, and like crypto arbitrager, an MEV firm, for example, might come in and backrun you and try to bring back the prices into balance. So it has sort of shifted to that, and I would recommend everyone to listen to the conversations we had about this last time. But it's an entirely new game that sort of develops from this.
But that's one of the things that I was reading through the Uniswap V4 protocol, is that you enter into this concept of hooks, right? And hooks allow you to basically programmatically inject smart contracts at any event in the pool's lifecycle. And one of the use cases that they outlined as a potentiality is you could effectively run an MEV as a part of the protocol and then return the P&L of the MEV back to the users of the pool, which is kind of cool. I mean, will it work? I don't know. Like, but I think that's sort of like you open up these sort of elements where you can effectively say, rather than having external forces, enforce the price of various pools and then give up, or basically pay rent to these various like external pools. You can have actually people that live within the contract itself and therefore probably have an inherent advantage in terms of like doing the MEV type of activities that an external force would do. And then by doing so, you can retain more value within the protocol itself.
Yeah, this is a very good point. So when we've just discussed this order routing and how this, like how crypto improves on traditional finance there, and that it was already possible or already present with Uniswap V4. But these hooks can allow exactly this to also solve or at least alleviate the MEV problem. There is this, they have introduced a special function called donate, where you, as someone who runs these MEV bots, then just donate parts of the profits you make back to the protocol, which allows then to give it back to either the liquidity providers or the users that do transactions. And I think it's a very, very interesting approach. And we've seen this also with this MEV issue in crypto a lot of discussion around how to get that back to the users, because it is people extracting rent from the system and something that should be avoided. And in crypto, the nice thing is you can, like, if you find a solution, you can put it into code and it will be there and no one can do anything about it and cannot actually game it, at least if you design it carefully. And I think the hooks might be an interesting solution to that, but they will also allow many other things, of course.
Like what, Nicholas? What else would they provide?
So we've discussed the example of limit orders, and one thing that hooks could do is bring actual limit orders to Uniswap. The issue was that if the price crosses your position, it does not get closed, and if it goes back up again, you sort of convert the tokens back to the initial state you started with. But with hooks that can hook, then that's sort of where the name comes from. They can hook into the life cycle at any point. So you could think of hooks that get triggered when, for a certain position, the price gets crossed, that this position gets closed automatically with on-chain logic. And this would be one of the examples where this can be used. What is really interesting about Uniswap V4 is not that they sort of do this, that they implement this kind of solution, but that they really rather offer you a framework to integrate arbitrary custom logic into pools, and thus allow anyone to come up with new and interesting solutions to these kinds of problems, and also with completely new features, of course, that can enhance the functionality of pools in completely new ways.
Do you know, do they plan to like just have these all in a repo that people add and then you can use them from like a drop down, or is it just you'll have to physically implement it and use it yourself? Or is there any discussion around that yet?
The way that it works is that the hook is actually a smart contract that you have to deploy. So and then in the pool lifecycle, the pool contract will call your contract with your custom logic. So you don't really have to put it in a repository. The repository is on-chain code, let's say, right? So anyone can have a look at like this specific contract that is deployed there and can look what does it do if the source code is provided, of course. So I'm not aware of plans for them to bundle solutions, but probably they will. I mean, they already have some examples available, and they will most likely put out like many solutions themselves for like the most obvious things you can do with hooks.
I actually think this is one of the nice things because they basically open source all the development work for tools, features, algos that people might want, and then they just get to work on the UI and making sure it's all integrated nicely and can focus more on user experience rather than...
This is a very interesting point, because there's also legal setup is that they don't really operate the protocol, the chain does. They are just a firm that develops technology that is then used by others, which I guess also has some legal implications and about running national securities exchange and whatever. And I'm sure there are people in your government that have very specific opinions about this.
No, that's not the case.
But there's also one other issue with that, and that has been like the topic of hot debates after the Uniswap V4 release, and that is their licensing. The Uniswap V4 will be released with a very permissive, like with a very strict license, the BSL license that forbids anyone to fork their code and use it in their own setup for at least the next 4 years. After that, it will go over to the license that allows you to do anything with it. But that has been the topic of a lot of debates, because strictly speaking, with this setup, Uniswap V4 is not open source. It's more like source code available, but you can have a look at the source code, but you cannot really freely modify it yourself. And I don't know. They obviously need to do this because they need to monetize it in some way. And we've seen after Uniswap V2 a lot of forks like SushiSwap and the likes that have done exactly this. So yeah, I mean, you have to find a balance somehow, I guess.
Interesting.
This might be a hot take for me, but a lot of people don't know this. But prior to going to business school, Carlos worked in the open source community. I worked for a software company that did open source. And there is a myth that open source projects are developed by coders in their free time that do something out of like the love of programming. And that is patently false. Ask anyone that's ever worked in an open source industry before, and they will tell you that that is just not the case. Typically, the way that open source projects, particularly large scale open source projects, get done is that you need to have strong like patron companies with, you know, a large budget that are basically working towards something with some sort of financial incentive to do so. Otherwise, you're basically at the whim of like, it's like herding cats. Like the community developer or the community manager job of a open source project can quickly turn into wrangling insanity if you have just a bunch of like, you know, tiny developers across the world who are all putting stuff in. So I'm actually a believer, because I've seen this in practice in the open source software community, that like you actually do need very strong centralized, you know, leadership in terms of like developing an ethos and a strategy roadmap and all that sort of stuff. And that requires money, because you need to pay developers, you need to have people that actually do the things that allow, you know, projects to get done. But I do think that it's important on the flip side to have, just from a feature development perspective, to have the ability to have the open source code, you know, available to make sure that it's auditable, to make sure that the community can have full transparency as to what's happening under the hood. So I'm not mad about sort of like a more centralized, you know, business license aspect to something like Uniswap, just because I've personally seen the sort of pragmatic nature of how software actually gets developed. That's my hot take for the day.
Is Uniswap V4 already in implementation, or is this just something that is being published, so being developed? Maybe some updates on, I don't know if this is something that a lot of market makers, traders are having to reformat to right immediately.
So the release that we've seen a few weeks ago is like a very early draft stage release, and the idea there is to invite the community to contribute and contribute like ideas, but also contribute early auditing. And I've seen on Twitter like first bugs that have already been detected in the existing source code. So it's still at a very early stage, and we should not expect a full release in the next few weeks or anything like that. It's more like an ongoing project right now that is now, after this release, being developed in public, which, I mean, is a good thing to do in crypto for sure, to build trust and involve the community early on.
I think there's some dependencies as well, right? For Ethereum upgrades like Cancun, for transient storage, which is they want to try and net off positions. So you don't, when you do a swap, you can, well, you can do netting as opposed to always just sending capital back and forth, which is very expensive.
That's a very good point. So one of the big...
Actually, I'll just make one thing, and then you can talk about this in a bit more detail, because I think this is the first two things we talked about. The first one Nicholas went over in detail was the singleton contract, effectively. This idea that you can have one pool to manage them all effectively. So you reduce fees by not having to go via like a routing engine. You route fees by doing it all in-house as opposed to basically going external, even though it's within Uniswap, but you're basically going to other contracts all the time externally, which is expensive. So that reduces fees, great for the ecosystem. The other one I'll let Nicholas talk about, which is the Flash stuff, and that requires an upgrade. And then the other thing is the hooks, and that's really about use cases for the chain. And that's the stuff I think everyone's more excited about, because you can kind of go wild with what you want to do there. But anyway, over to you. I just wanted to summarize those things. I think that's really what we've covered so far.
It's a very good point. So I mean, we've discussed that having pools sitting in different or living in different smart contracts, each holding their liquidity reserves separately, adds a lot of disadvantages and makes transactions much more costly. And so with Uniswap V4, one of the big upgrades that we will see is that all tokens will be held by a single contract, which is or should at least improve on the transaction costs a lot. What this allows you to do is, like you just said, man, to not transfer tokens at each step in between, but only transfer net balance changes, essentially. But the most efficient way for this to do this would involve using this transient storage. So these are essentially variables that you don't need outside of this specific computation context. So sort of within this function call, you need to store how the balances change, but you don't need all of them to become effective, only the aggregate net change in balances at the very end, which might be much less complex than all the individual steps that they consist of. And so Uniswap is being built. Uniswap V4 is being built around like sort of this Ethereum improvement proposal to be integrated, which I think is on track to be included in one of the next upgrades.
Do you know when that is? It's like, I think it's pretty soon. I can have a look in the background.
Yeah, I'm not quite sure when exactly.
So there's actually kind of, once again, a corollary to traditional finance, because this is actually, if you think about it, like a massive improvement to the way things get done. So I'm going to outline in the FX world, you have this concept of an FX swap, and you have swaps everywhere, right? But like an FX swap is really sort of something that says, I'm going to lock in the rate today for some transaction in the future, right? And there are various components of that swap. It's a way that people will hedge their currency risk. So let's say, for example, I'm a US company, and I buy a foreign asset, and I want exposure to the asset's risk, not to the currency pair in which that asset is denominated. So what I'll often do is I'll enter into a swap that basically compensates me for the difference between my, US dollar risk and, I don't know, like Euro risk or Swiss risk or something like that. And there are various components of this, but usually what it incurs is a FX spot transaction at the beginning, and also an FX spot transaction at the end. And then I pay the interest rate differential between those two currency pairs. Now, it used to be in finance, like an easy way to fleece your customers is to sell each component separately, right? So I'd have them pay a basis point on the, spot transaction, and then I'd have them pay a, basis point on the interest rate differential, and then I'd have them pay a basis point on the, on the ending spot transaction. And, now I'm earning like 3 basis points, and it's fantastic. But the only risk you're really taking is the swap risk, the interest rate risk.
Mm-hmm.
And ultimately, some enterprising banks said to themselves, why don't we actually just kind of wrap this into a single contract, and we don't need to charge a bunch of different fees along the way. We're just going to net everything down. So now you have one contract that encapsulates the risk of the spot transaction, of the interest rate differential, transaction, and then also the outgoing spot transaction. And we've made it cheaper, and we're going to earn a lot more business because, we're just going to get rid
Low
of some
cost
of the
provider.
fees and bundle all of these sorts of things within the concept of like a derivative contract, right? The problem with derivative contracts is that they're very opaque and they're owned by a specific bank, and you really have no idea what's happening underneath the hood. So when you have this concept to be able to like pool fees and net everything down, right, it does deliver you a significantly lower cost version from a transaction fee perspective, but it doesn't do so by wrapping it within an opaque derivatives contract that you have no idea what's going on. It's kind of an interesting paradigm where Uniswap V4 and some of these like technological things allow you to have more efficient netting, reduce fees, and do some interesting stuff without needing to like first wrap it in some sort of like opaque OTC wrapper that only the bank itself knows what's going on. I don't know, Matt, you can correct me if I've said anything stupid or crazy, but that's my view in terms of like the kind of cool stuff that Uniswap V4 unlocks.
All good. It's later this year, by the way. That's the plan for Cancun.
That's fascinating. It's so it's almost like you're having these customized derivative contracts, as you see in traditional finance, that are owned by banks. And because I remember going through the great financial crisis, and one of the biggest I guess one of the most terrifying aspects of investing in a credit hedge fund, for example, was their credit swap exposure, because before the global great financial crisis is that none of those swaps would be netted down. They'd just be all traded with different banks. And so you'd be net neutral. But you might have a lot of notional exposure, and you never really knew who had what notional exposure where. And after Bear Stearns went bankrupt in Lehman, it created this whole concept that there is credit risk within these underlying institutions. And so it sounds like with some of this work that's being done through Uniswap and more customization of these contracts, is that you can create some of that transparency intrinsically in the protocol.
Yeah, and I think that's so. If you look back to sort of like circling back around, and maybe we can end here on this point, which is you look back on what Larry Fink said, like the ability to mechanize finance through smart contracts and tokenization is massive, because right, the reason why all of these derivatives and credit exposures exist on the TradFi part of the world is that it's so operationally inefficient to own all of the, like, if you're a hedge fund, you're not going to go out there and open up a bunch of these like individual pieces of risk that make up the underlying of a derivative contract, right? And so banks thought to themselves, oh, well, let's just kind of like take these financial Lego blocks and put them together and then offer only the risk exposure that the clients wanted, right? And then we'll own all the operational risk, and we'll charge spread, and then we'll give some credit, and all that sort of stuff. So what you get is sort of like the end product of a DeFi protocol, but it's wrapped in a very opaque OTC wrapper, and you take credit exposure to the counterparty that did all the wrapping for you. Versus the technology of a DeFi protocol allows you to create that in a open, transparent, secure protocol, and then handles it on chain such that you get the end outcome, meaning through DeFi protocols, I have the ability to mix and match various underlying components such that I get exposed to the risk that I want. But it's also wrapped on chain, so you're not taking bespoke credit exposure to random financial institutions, and you have no idea, or rather, you have a lot more transparency in terms of like how that is constructed and what the fees and the sort of operational exposures are on every part of the value chain.
Fascinating, guys. This is awesome. Nicholas, it's always a pleasure. I feel like whenever we have you on, I wish we had like an extra 20 minutes to pepper you with questions. This has been great stuff. Thank you very much for joining us.
Yeah, thanks. It was a very, very interesting discussion.
Everyone, thanks a lot. Appreciate it.
Yeah. Cheers, guys. Bye.
Cheers.
Cheers.
Bye.
Bye.
Bye.